down by 2.75%.
The bigger picture, of course, is that 2011 has been a year of low volatility and low volume. The average daily trading volume in the first 4 months is down 15% from where we were a year ago. The stock market is a much quieter place today. Could high-frequency trading, oddly enough, be to blame? Are technical algorithms now the leading indicator of the markets? Joe Saluzzi is co-head of equity trading at Themis Trading, and Justin Schack is managing director at Rosenblatt Securities. I guess for both of you, really, high-frequency traders are the enemy.
Well, high-frequency traders, they've evolved with the regulations, okay? And they are out there all day long trying to pick off or detect institutional order flow. That's the way it works. And they're out there sniffing around and pinging through different algorithms, like you mentioned. And actually, it was funny, and I think Justin will comment later, that one of the high-frequency trading firms today announced that they have a product now to help institutions detect themselves. So, why are they're actually offering institutions a way of figuring out where the high-frequency guys are. So what's going on here is it is a parasite and a host situation. Institutional volumes are down, they're the host. If there's no host, the parasites can't form.
So put this in context for us, because Justin, right now we have very, very low volume. We have very, very low volatility.
Yep.
The computers, I would assume, don't care at the end of the day. It's all about where stocks are, if moving averages are breached, certain trading patterns and correlations. So why aren't we seeing the volume pick up at all, given that computers are dominating so much? Why aren't they just triggering programs?
I think you're right that the computers themselves don't care, but the computers are controlled by human beings, and human beings give them instructions. We have a slightly different view about high-frequency trading than I think Joe is espousing here. It's not as if it's a parasite and host type of situation. High-frequency is simply the new way that liquidity is provided to investors in the marketplace. There have always been traders that try to get an edge over other traders. There was never some situation where it was always a fun game and everybody cooperated with one another. So I think people need to be aware of the high frequency market makers if they're institutional traders, but it's not necessarily a friend-enemy situation. The computers themselves are being programmed by folks, many of who are high frequency and who thrive on volatility. So with volatility down, they're going to be trading less. When demand for liquidity is up, such as in a situation like we saw in the crisis, late 2008,
so they will
early
come back to
2009.
bite us. They exacerbate wherever you are. If it gets really quiet, they quieten right down. If it's suddenly the volatility comes back, they will thunder back into the market.
Liquidity providing is such a tough term. They take as much liquidity as they provide. May 6th of last year proves, and the SEC analyzed it, they took enough liquidity, and but the real problem here, by the way, is not necessarily the high-frequency traders. It's where we are right now.
So let's
exchanges
talk about
provide
that,
the data feeds
I don't want
to
to make this another debate about the pros and cons of HFT. I mean, we've done that. We've been there. So in the context of today, Joe, what are we seeing at work in this market of low volume and low volatility?
There are a lot less institutional volumes out there. There's no doubt about it.
Where are the computers?
Where are the computers? They have nothing to trade off of. Again, back to my parasite host scenario. If there's nobody out there to feed off of, you can't make money. So they go to different asset
They're
classes.
just tools.
I see a market here. Hang on, there's a market here that's down 157 points.
Where are all those liquidity providers? Where'd they go?
What role is the automated trader?
They're providing liquidity to people who want to sell.
Well, here's the deal. When you take a stock with an average daily volume of 10 million shares, of which maybe 70% of it is just noise going back and forth, and if you're an institution, you've got an exit 1 million shares of that position, you think it's 10%, but in fact, on a day like today, you'll be 30% of the volume, you're going to drive it down.
The fundamental thing here is that people with investment views drive the market. The computers don't drive the market.
Joe, Justin, we've got to leave it there. Thank you very much. We're tracking, of course, the markets on our big slide, 153 down, sitting at our lows.